Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And away we go, Sonu. This is episode 91 of Carson's Facts versus Feelings. We're titling this one, Why Nvidia Can't Stop This Bull Market. Or maybe I should say, why even Nvidia can't stop this bull market. A lot to talk about there. Sonu, I am down in Charlotte, staying at a friend's house. You can see I'm not my normal backdrop here, but hopefully you can walk me through how to do one of these. I do have soccer balls behind me.
I know you became a soccer fan in in those 2-3 days since I spoke to you last.
Since it's not my house, I have to abide by the house rules. You got to do soccer balls because it's the Euro Cup, and I do remember this though. In the year 2000, I went over abroad, went to Xavier University, one of those summer abroad programs. Probably drank a few beers from what I remember, but I do remember it was the summer 2000. The Euro Cup was there, and just going to every country, how they just truly. It was just amazing how it's just everything revolved around that game. I remember going to Holland and everything was orange. I mean, orange is their color. Right. And I don't know. Maybe I should look it up, but there's not a ton of, we have listeners. I know for a fact we have listeners in Holland. So shout out to Holland. But
Holland's like smaller than Holland.
Yeah.
The Dutch, I've the first sport I remember watching is really the 1986 World Cup. And I was really young. I was just 8 years old, so there's not much registering. Maradona was big at the time, but that's just about all I remember, that he winning the trophy and all that. But 1988 was the first tournament across any sport I saw. 1988, the Euro Cup. And the Dutch won that. And ever since I've been I've been a Dutch fan. So, if the U.S. is playing, I root for the U.S. India's never registered, so it doesn't even matter. So I've always had to pick some other team. But the orange, or the Oranje, as they call it, that's the team I go for. And
there we go. So my old college roommate was Dutch. Back at Xavier, he played soccer there. So yes, I'm connected. Anyway, so that's neat. So the Euro Cup is going on right now, and that's why I've got some soccer balls behind me. But let's just get into it, Sonu. So we're going to talk a little bit about three different things here: the bull market, the summer rally, a little talk of July, the first half of the year, what's it mean for the second half of the year? Talk about that. Then Nvidia. I mean, it's a stock of the day, stock of the week, stock of the year, stock maybe of the decade. The way this is going, stock of all time, because it literally was the most valuable company in the world for about a day or so last week. Then a little macro backdrop. Had some good news, some bad news. Where does it all stand? Let's talk about the bull market, Sonu. So stocks continue to make new highs. We've hit 31 new all-time highs this year on the S&P. That extrapolates out to 66. I mean, that is like getting close. 77 is the most ever in 1995, and we hit about 70 or so a couple years ago in 21. Just pretty amazing, isn't it?
No, exactly. And the S&P is up 15%, but this is the thing, right? This is where people are like, oh, is this, the phrase to put it, irrational. Right? Is this irrational exuberance? Is it too much? For one thing, I mean, you showed a stat to our partners this morning that was very interesting, that more people are planning to reduce exposure to equities, or it seems like most people are planning to, barely 17% of those institutional investors or managers who manage money are planning to increase equity exposure here. And we're like, wait a minute. And what's interesting, everyone knows that momentum sort of works, right? I don't think you'd get an argument from anybody who's been in markets, for a reasonable period of time that momentum doesn't work, right? But then you look at like record highs, all of that. It seems like, no, I'm skeptical. I don't like this bull market. It seems like there's a lot of that, Ryan.
Yeah, look at any of my tweets. People hate higher prices, but that was actually JP Morgan. They do a survey of their institutional clients, and it came out only 17% expected to increase equity exposure over the next. It's a days to weeks.
That's
so we'll just call that. What was that?
No, I said that's incredible. That's such a low number.
It is, and that's a little. The chart that they share goes back 3 years. That's like the lowest in 3 years. And again, you pointed out in late 2021, everybody was bullish. What happened after that? Remind us, Sonu.
Yeah, no, 2021. So just for, we don't have the chart here. If he can share it, I mean, I'm sure Ryan will throw it up on his Twitter feed. Maybe you can retweet or something on Carson Investment Research. But yeah, look, in 2021, that same number, right, where it's 17%, 17% right now, it was around 65, 70% across 2021. And then boom, you get into 2022. And actually, through the first half of 2022, it looked like people are pretty bullish. It was after the Fed got really aggressive. That's when, set the tone for bearishness. And I don't think we've really moved out of that bearish regime. I mean, you've seen little peaks. Maybe it's gone up to 50% end of last year, early part of this year. But, I don't think there's any exuberance here.
No, well, obviously the terrible war started also in March of 22, and then the Fed got real aggressive in the middle of 22. So lots of just bad stuff swirling and out there, and that obviously led to a vicious bear market, 25%. I mean, maybe vicious. It felt vicious at the time. Historically, that's kind of an average bear market until you live in one, and it felt pretty vicious. But most of those Mag 7 that we know and love, and everybody knows them, we're going to talk about them here in the next. They're all like cut in half, if not more. So just something to think about there. But again, let's talk about all-time highs. So here's a little bit. So by the way, we're not going to do the podcast next week. It is the week of July 4th. Honestly, we could have done it, but I don't know. We're going to take a week off. And what happens when we come back in 2 weeks, Sonu? Let's drop a little teaser here.
That's our mid-year outlook. So keep your eyes on the price. That's literally the theme of it. Not the theme. It's the title of the outlook, right? Eyes on the price.
Yep. Mm-hmm. Unless we change it, but that's the title as of today. But yes, yeah. So obviously, we've been one of the more bullish places out there. So we're still pretty optimistic. If you've been listening to this podcast, which I know a lot of you have been, so thank you. We're still pretty optimistic, but we'll go over our mid-year outlook in 2 weeks when we drop the next facts versus feelings. But here's a few things to think about, Sonu. So again, we got 31 all-time highs the time we're recording this on the S&P. So I looked at the middle of the year, the midpoint of the year is probably a better way to put that. When you have at least 20 all-time highs, which clearly we're going to this time, the rest of the year up a median 9.6%. What in the world does that mean? Well, you're at any year, median return the last 6 months is 5.6. You're talking 400 basis points of outperformance. When you have 30 all-time highs, that goes to about 9% median. So again, better than expected returns going forward is just one way to look at it. But we'll get into the macro stuff here, which is still pretty positive. The other one is if the S&P is up 10%, so double digits at the midpoint of the year, like we likely will be this time, the rest of the year median is 9.8% and higher 83% of the time versus, again, you're at any time median of 5.6 the last 6 months and higher about 72% of the time. So now the reason, Sonu, I use medians in this particular case is 87 shows up a lot. And if you do averages, there's not a ton of sample size here, I'll be honest. It does skew things. So I use median for that reason. At the same time, you said it once or twice, momentum begets momentum. A good first half could mean decent second half. What do you think?
Yeah, the three things, right? You said like new highs, like the number of new highs leading to more momentum over the second half of the year. And then, a really positive first 6 months of the year. And then the election cycle, I'm sure you'll have the stats on that. But, that's been positive. You've been running much better than the typical election cycle or average relative to where we are this time of an election year. So all those three things, you put them on top of each other, you're kind of giving it away that, what was that target at the beginning of the year in our outlook? 11 to 13%?
11 to 13 total return on the S&P, which felt bullish at the time. After 25 the year before, it felt kind of bullish.
Yeah. And the market's up 15%. So you think, we're not bearish, right, Ryan?
No, we're not. And I will say, so great point about election year. So the best start to an election year ever was 1976 at this point, which is just a tad better than right now. Now, the final 6 months in 76, I think we only gained like 2 or 3%. So kind of choppy, not much gain there. Just be aware of that. But the one stat that got me, and I've shared it a ton, it's an election year. We all know that. But when you have someone up for re-election, right, a first-term president up for re-election the last 10 times, S&P's been higher 10 times. 12.2% on average. To be honest, you look at where we started this year, we said between 11 and 13. Back of my head, I saw that number with some other numbers. We saw a lot of numbers that kind of landed around 12. And that suggested, again, likely strong performance. And then the fact the economy's been pretty good. Inflation's coming back. We'll talk about all this stuff. The Fed's turning more dovish. That's led to even a better year. What else you want to talk about from the stock market point of view, Sonu, before we go forward?
So I just read this great blog from our friend Ben Carlson
Yep.
over at Ritholtz and Animal Spirits. So Ben's writing has always been fantastic. He has this very good question about like when is mean reversion coming for the stock market, right? So he put this tweet out: last 5 years of S&P 500 total returns. 2020, 18%. 2021, 29. 2022 was negative, okay, negative 18. But 2023, 26%. 2024, we are sitting at 15 to 16% right now. And I must admit, I haven't looked at where the market opened this time, but safe to say, more likely to be up than down. But anyway, it's about 15%. So the question is, okay, is this abnormal? Are we going to mean revert, right? So I thought about it two ways. One is the total return from 2020 to 2024, mid-June, like mid-year, let's say 4.5 years. Annualized return, its total return is about 82%, right? That's about 14 to 14.5% annualized, right? Now you, again, break it down. You know, I like to do this. Break it down. Returns can be broken down into how much comes from earnings growth, how much comes from multiple growth. Think of that as sentiment, how positive people are about future earnings, how much they want to pay for it, multiple growth, and then dividends. Out of the 82%, 65% have come from earnings growth and dividends. 65%. So 52 percentage points out of the 82. Wow. Much more than half has come from earnings growth. Another 13% has come from dividends. So don't discount dividends, even though dividends are like 1% per year, 1.5%, 2% per year. No, over the long run, it matters, right? Multiple growth accounted for just 17%, right? So 65% you can think of it like fundamentals, earnings growth and dividends. The rest of it, 17%, was multiple growth. So most of the return, the 82%, came from like, solid fundamentals for companies. And then I think about, okay, let's look at it another way. Like I said, 82% over 4.5 years is about 14.5% annualized. That's actually not unusual for 5-year periods. From 1928 to 2019, 39% of rolling 5-year periods have seen annualized returns above 14%. Right. So that 14.5% that we've seen, let's say, even if the market is flat for the rest of the year, it'll be about 14% annualized since 2020. That's not unusual, right?
Somebody just emailed you. Someone wanted to check in with you there. I don't know. So no, great stuff there. And again, yeah, I know. No, if you're not following Ben, I don't know what you're doing, but Ben puts out, it's like every day. Ben's like a machine putting out amazing things. And I believe if you go back to 2009, I believe the S&P is up about an annualized right around 14% as well. And we've talked about these things before because, listen, yes, that's great. But from 2000 to 2008, how did things go, right? 50% haircuts. Literally the aughts, I guess is what we call the aughts of 2000s, was the worst decade ever. Worse than the 30s for investors. So think about that. So yes, this has been an amazing run. Unfortunately, a lot of people, I believe we do this for a living, a lot of people have not believed in it. I mean, they lost their money twice during things. A 100-year pandemic happened. We had very close bear markets, 2011, pretty vicious start to 2016, although it wasn't technically a bear market. Had another near bear market late 2018. I mean, it's been then the 100-year pandemic. It's been anything but easy along the way. But I guess the thing we continue to try to stress is, listen, if you're in this for the long run, which hopefully most investors of this particular podcast are, you should use those opportunities. We're going to have pullbacks. We're going to have bear markets again, but to use them as opportunities going forward. But that's some great context there. Oh, one more thing about new highs. The S&P hit one new high the entire calendar year of 2022 and 2023 combined. One all-time high in 2 calendar years. Okay. So that puts in context is 31 we've hit this year. Yeah, it sounds like a lot. It is a lot. But we didn't have any for a long time. And again, that's just put a little more context around this. I did do one tweet, again, from a chart that you share, the forward 12-month earnings expectations in the S&P up to 259. What in the world does that mean? Well, it was like 225 at the start of 2023. Bottom line, earnings have continued to soar and improve. But what gets me, and I love looking at sentiment, is I look at the comments to that tweet. That tweet kind of went viral, to be honest. The comments, and a good chunk of them are like blaming debt, blaming Jerome Powell, talking about the standard stuff. The standard stuff that are just people that are angry about a bull market. And it's kind of like we've made half of a joke a while back. We talked about the market being rigged. And I said, it's rigged to go up. I mean, look at history. The market's rigged to go higher. So maybe we shouldn't be complaining so much about that. What do you want to add? Maybe the final thing we'll talk about, then we'll move forward. What do you want to talk about? Anything there?
I mean, it's one thing to say the market's rigged, but profits are profits, right? I
Yep.
mean, maybe, government spending, all of that, whatever, right?
Yeah.
But it is what it is. You live with the world as it is. You don't live with the world that, like, what you wish it to be.
True.
So, that's all I can say about that.
Yeah, and another thing, it upsets people, but also it happens. Well, what's the S&P? What they just do, right? Rebalance. Okay, they kick the losers out and add new growing companies. The Dow does the same thing. Dow doesn't always have the best track record with doing it, but still, Dow's flirting all-time highs too. So that's just the way this works, and people get mad. Well, they kick the losers out. It's like, well, what do you want to do? Yeah, if I'm a fan of the Cincinnati Bengals. Do I want them just to keep all the terrible players? I mean, like, no.
You want to be the Chicago Bears? No.
They have a team. Does Chicago even have a team? I don't even know. Like, that's what I'm saying. I don't even know. Teasing there, but no. I mean, so anyway, just a lot of people that are still angry out there. And again, from that contrarian point of view,
I have an interesting stat
Go
about
ahead.
the S&P 500. To your point about it being sort of like a longer term momentum index. It basically reflects the best companies in the US, right? And, that's what the committee is trying to capture when they pick about 5% of the index out. But here's something interesting. 500 companies, and people think of the S&P 500, oh, this is buy and hold. I buy it. And yes, the index itself is buy and hold. But a lot of things shift underneath. 2015 to 2024, 180 companies that were in the S&P 500 in 2015 are no longer in the S&P 500.
Wow.
180 companies over little under a decade have been thrown out of the index because, and we're not mentioning names, so it's safe to say they were the losers, right?
Yeah.
But that's how much turnover has been there in the index. But when we buy, say, the S&P 500, an index fund or something, it looks like, oh yeah, it's just buy and hold. But underneath, there's a lot of churn, and it reflects the economy.
No, well said there. So again, I mean, we've obviously been overweight equities for a while. We still think that's the way to go. We'll talk more about that in 2 weeks when we release our mid-year outlook. So let's talk about Nvidia, the stock of the day, stock of the hour, stock of the year. I do have a little. Maybe I'll do that. I've got a little story about something, but I'll do that when we talk macro. So we'll get there in a second. But the Nvidia for a minute, was it last Tuesday or Wednesday, Sonu, most valuable company?
I think it was Tuesday because I think it went down Wednesday. But so over the entire week, and by the way, it's not a recommendation to buy Nvidia, sell it,
right,
whatever, right? We're just talking about this stuff. Nvidia is down over the week for about 4%. I think Wednesday, Thursday, Friday was down. So I think it was Tuesday. It overtook Microsoft as the largest company in the world by market cap.
Yeah, it was up like I've got in front of me 3.38. Microsoft was like 3.304. Now I'm going to list 12 companies for you, Sonu, and all of these, according to our friend Howard Silverblatt over at S&P, who kind of is the gatekeeper for this. These were at one point the most valuable company in the S&P 500. He went back to 1926. Now technically it was the S&P 90 back then, but you get the picture. Mm-hmm. These were we've got Nvidia, we've got Microsoft, Apple, Cisco, GE. Now it's called GE Aerospace. I didn't even realize that. I guess they added aerospace. Yeah, well, according to our friends at White Charts, that's what it looks like. IBM, Philip Morris, Walmart, ExxonMobil, DuPont, and AT&T. I'll be honest, DuPont's the one that surprised me. The rest of them, I think, made sense. Maybe Philip Morris to a degree. And I will say this, so no, I was surprised U.S. Steel's not in there. I would have just assumed U.S. Now, maybe U.S. Steel would have been a little earlier in the 1900s looking back. But those 12 companies, the key thing again, evolution, things change, growth. IBM's obviously struggled for a while. Some of those companies have struggled for a while.
IBM had a long run. Like if you think about the longest run, like Apple's been over the last decade, Apple's been number one for a long time.
Yeah.
But the biggest record number, I think, was probably IBM all the way from 1965, 1966, all the way through, the end of the late 80s.
Wow.
Almost till 1990, almost IBM was up there. And before that, it was AT&T, by the way.
Yes.
AT&T Bell Labs all the way from 1950. I was looking at a chart, 1950 to 1966. And then it was dethroned by the tech company of its time, tech company du jour, which was IBM. And then we had a lot of churn. What was interesting is since 1990, we've had, I'm looking at a chart, we had Exxon in there, we had GE in there, and then GE got dethroned in between for Microsoft during the dot-com bubble, and then GE came back, and then it was Exxon in the mid-2000s up until the financial crisis.
Yeah, I'll tell you. I mean, again, not a recommendation, but the fact that Microsoft usually once they're the biggest, they lose it. It
Yeah.
doesn't come back. I mean, that's usually how this works. The fact that Microsoft was the biggest and then dethroned for a while kind of changed their company in a way from what they used to be to selling Microsoft Office and Excel to doing a lot of other stuff now on the edge of AI, leading edge of AI. Pretty amazing. Kind of interesting. Amazon's not in there. I guess I might have thought Amazon at one point would have been the largest, but clearly not because they're not
Amazon
in
was
there.
I'm looking at my chart. Amazon was number 3
Okay.
for 2018, 19, and 20.
Well, there we go. So they were close.
They were
They were
close.
the
They were
the
very
bridesmaid,
close.
I guess you call it bridesmaid. I
Yeah.
don't. Yeah.
The
So
most consistent company in terms of being in the top 1, 2, 3 over time
Mhm.
since 1950,
Yep.
Exxon,
How about that?
consistently, right? I mean, over the
Yes.
last decade, it's not been close, but Exxon's by no means gone away or anything like that, right?
Which brings one of the more amazing stats, and we talk about a lot of stats. For a minute, and I don't know, it might have been literally a minute, a cup of coffee, Zoom was worth more than Exxon back in, I guess, 2020. Zoom stock, I think, is down like 98%, 99%. Don't quote me there, but it's down a lot from that peak. And we use Zoom all the time. I mean, I still use Zoom. I don't know. I mean, I guess I use Exxon too when I fill my car up in a way. But nonetheless, for a minute there, Zoom was worth more than Exxon, which well, that's not the case anymore. All right, so anything else? Okay, let's bring this.
You want to talk Nvidia's a little
Yeah, let's go. Let's talk Nvidia 5 minutes or so. So, how worried should we be? I mean, this company has grown incredibly. Now they're, I think, 16% of the of the Nasdaq 100. It just changed. I mean, whatever the number is, it's a lot more.
Morning too, while we're talking.
Yeah, it keeps going up. I mean, how worried should we be that there's this one company that literally, I hate to say, came out of nowhere, but in a way, the last couple of years they kind of have. What do you think?
I'm not worried.
Mm-hmm.
Short answer. I'm not worried.
Good.
I mean, this I've learned last year. You told me about. I've kept this in my mind, which is kept a lot of things you've said in my mind.
I can't wait to hear what I've told you. It's probably something about the dessert or steaks or
You want your leaders to lead.
Yeah.
You want your leaders to lead, right?
Yeah.
You don't want your leaders to lag. Well, if it lags, if everything else is doing well, so be it. But you want your leaders to lead, and that's what's happening in Nvidia. And then you think, okay, is it too stretched? Maybe, but really. Let's go back to January 1st, 2023 through June 21st, 2024. So about 18 months, just under 18 months by a week. NVIDIA's total return is 767%. 767. That's crazy. Think about 767%. Out of that, it'd be one thing if it is all multiples.
Sure.
Right? It was all sentiment. Like, oh, I think NVIDIA is great. I'm okay paying much more for future earnings growth, whatever it may be. No, it's not that. Out of the 767%, 700 percentage points came from earnings growth, forward-looking earnings growth. Multiple growth, sentiment basically, accounted for just 67 percentage points, right? Wow. NVIDIA is an earnings story, blowout earnings story. That's what's, that's the story here. I mean, revenues last year hit 262% year over year in the last quarter, I should say. Up 200 to $26 billion. That's insane. Mm-hmm. It was like 11 billion or something, which, by the way, it's not a bad number by itself. That was in 2023 Q1, but it went up to 26 billion Q1 of 2024. I mean, what do you say to them? It was all earnings growth. It was all profits.
Yeah, well, I guess what I would say was we hear, is it a bubble or not? And we don't think the stock's a bubble, but obviously maybe it's stretched. I mean, listen, up as much as you just said, hey, listen, I don't care who you are, that's stretched. But remember in the late 90s, early 2000s, tech bubble imploded. I mean, forward PEs were, a lot of companies had no PE because it made no money. Okay, let's just start there. But the ones that did are like forward PEs of 200. Now, Nvidia's forward PE, I think, is in the 30s. A lot of the Mag
right 7. Now it's about 42 times.
Okay.
Going back to your comparison, Cisco, I just looked it up last night. Okay. And Professor Siegel mentioned this when he was on our podcast last week. Right. We talked to him last month. Cisco was 200 times, right? Yeah. 200 times back in early 2000, in March and April of 2000. Cisco was 200 times. By the way, it was number going back to our, like top 3 valued companies in the across history. Cisco was like the one-hit wonder. For a brief period of time, it was the number 3 stock. I think it was 99.
Well. So a little story there. The very first stock I ever bought my entire life was Cisco. And I remember it was over $80
You should
a
ask
share
me
at
to
the time.
guess.
Yeah, it was literally, I think I bought the high. I think literally March 2000. I think it was like,
Sorry, I
I
shouldn't
think,
laugh. I mean, but
oh no, it's funny. I can laugh. I can laugh. No, but you live. It's all over TV. It's got to be good. Learned a lot there that you don't always blindly buy unless it's us talking. You can listen, but
yes.
don't always. Anyway, so all right. So Nvidia is justifying where things are. Just a little bit more though. As of last week, after the stock split, Nvidia's 50-day moving average is right around 100. Now the stock was up over 140. Okay, that is a very stretched rubber band. I know this was on Thursday, Sonu. They had what's called a bearish outside day or a bearish engulfing day. Keep it simple. The high on Thursday was above the high on Wednesday, but it closed beneath the low on Wednesday. Or on Thursday, closed beneath Wednesday's low. What's that mean? Again, that's kind of an ugly day. If you bought any time, you're down. Okay, like that's what it means. The last time we saw something like that on Nvidia was on March 8th. What happened after March 8th? Well, the stock went in a bear market. Now, this is the definition of bear market, 20%. This stock, most of us realize, 20% pullback, probably normal. Honest to God, probably healthy. So we saw a 20% pullback back in from March 8th until the middle or so of April. Then the market kind of continued. So who knows? Maybe, and this stock pulled back a good amount last week, like you said here from the high. Maybe it goes in another quote unquote bear market, 20% pullback, 20%. But it's like as many gains as the gains it's had. It's I hate to say bear market because I think most of us realize it's probably just normal to be there. But the question then, Sonu, let's say there is some weakness from Nvidia. Will the baton just be passed around or will the market struggle in general? What are your thoughts there?
I think so. I think as long as the economy is going good.
No, wait, I think so. I gave you two questions, Sonu, and you said I think so. So are you agreeing to both of them? You're getting better at this. You're getting better at this.
There you go. I'm learning from the master himself.
Yeah, you just talk a lot. And you use funny sayings and you quote. You just quote like Patton all the time, and they throw you on TV. It works for anybody. Trust me.
Yeah. Look, where were we? I lost my train of thought.
I don't know. I said as the market goes down. I'm sorry. Nvidia. Let's say Nvidia pulls back a good deal. What's it mean to the market? Mm-hmm.
I think that's okay. I mean, last week Nvidia was down. By the way, like I said, Nvidia was down 4%. Apple was down 2.5%. So the leaders lagged, right? But everything else was up. What 6 out of 11 sectors, 7 out of 11 sectors were positive. Financials, especially. Energy kind of dances to its own tune. So set that aside. Financials, industrials, all that was up. Consumer discretionary was up. Yes, that's Amazon and Tesla, but other things can go up. And as long as the economy is doing well, nominal GDP growth is around, especially now, 4.5%, 5%. Over the last decade, we average about 4%, so it's higher now. Remember, nominal GDP growth is where profits come from. If that's going well,
right? And
profits, we're talking about aggregate profits, right, across every company in the U.S. So, I think things are positive, and other things can absolutely take the baton there.
No, I think so too. And again, last week we saw some of that again, where we saw some outperformance of the small and mid caps. Industrials did well, financials, some of those other areas that we think, which is kind of the next part of our conversation. If we get continued better inflation data like we expect, if the Fed starts to actively cut going forward, we could see more dispersion. I know it sounds crazy right now. Like, why would you want to touch small caps? Why would you want to touch anything besides large cap tech? Well, once everybody loves it, maybe it's a little harder to go up. Some of those underloved areas are where you should look. So, Sonu, we've got a few more minutes here. Let's kind of move forward. We'll talk about macro, but I want to give like an anecdotal example of inflation coming back. So I'm down in Charlotte for the week. My one son Sebastian, my 13-year-old, he's the middle one. We used to live down here, and he always went to Winthrop. Winthrop is the school in Rock Hill. We lived in South Carolina, just south of Charlotte. So anyway, he's gone from like first grade to now at this basketball camp. So we can't stop now. So anyway, so he's going into 8th grade. So got one more year. So we're down here doing this basketball camp and hanging out. And on the way down, I brought the boys. My wife's up in Ohio with Susanna. She's got a cheer camp. So, he's juggling everything. Long story short, there's a place called Cookout. Have you ever heard of the restaurant called Cookout? We'll start there. Have you ever heard of that?
No, I can't say I have.
Well, it's more of a southern-ish, kind of down here, Carolinas, Georgia, Tennessee. So Cookout, like the name would suggest.
Okay.
What?
It's a chain.
It's a chain. And like the name would suggest, it tastes like when you cook out. Like it's got like the hot dogs are kind of burnt, the hot hamburgers kind of burnt a little bit. It just tastes like you just cooked it on a grill.
Okay.
With some charcoal. And it tastes great. So anyway, we haven't been to one in a long time. It's just something different. We were starving, driving down the roads. Oh, boys, Cookout. Like, yeah, let's go. So listen to this. We all got like a burger, and they get this thing called a platter where you can get like 2 sides. You can get like some onion rings and like a chicken quesadilla. Now, it's not very large, but I got like a burger, onion rings, chicken quesadilla, and a milkshake. Okay. The boys did the exact same thing. It was $29 for all that.
Oh,
I said,
okay.
I mean, I couldn't tell. I mean, like, I'll go to like Arby's. Okay. And Arby's is like $29 for like 2 people. I mean, it's so expensive. And so I went to Cookout. I was like, oh, there we go. And it was a ton of food. So, hey, that's my anecdotal sign that maybe there's some inflation things starting to improve. I can't tell you the last time I fed myself, my 2 boys for under $30. I don't know the answer to that. It doesn't happen. I mean, honestly.
Like you go to Starbucks and you spend $30.
Oh yeah, my daughter spends a lot of money at Starbucks. Yeah, she's always going there. She always like, well, they gave me a deal. I'm like, well, yeah, they gave you a deal because they got the algorithm. They know what they're doing. You save a quarter and you show up and you spend $19.
You mean I gave you a deal as your dad?
Oh yeah, that's very true. Anyway, so let's get into the macro backdrop here. I mean, last week we had retail sales come in a little bit weaker, but industrial production was strong, and then we saw some PMIs came in stronger than expected. There's probably some more stuff out there. Where do you want to start, Sonu, with some of the macro data? Because it was kind of a mixed bag last week.
Yeah, I think retail sales. Let's go retail sales. But remember, retail sales is all goods, and it's all nominal, right? Which means what? Mm-hmm. It's not adjusted for inflation. I mean, so retail sales are up 0.1% month over month, right? It was below expectations. But part of that was because gas station sales were weak. And why are gas station sales weak? Well, because gas prices fell and gas station sales fell 2.2%. Auto sales, I mean, this is where I think prices coming down, to your point about inflation, right? As prices come down, that, kind of confounds what we see in the nominal spending data. Right. So if you take vehicle sales are up 1.1% annualized last 3 months. Mm-hmm. Doesn't sound that great. It isn't that great. Right. But that's because prices have been falling recently. We've talked about used car prices coming down. New vehicle prices have been falling for 5 months. Right. Probably longer if you look at private sector data as opposed to official data. But let's go with official data. 5 months, new vehicle prices have been falling. So I think what's happening is 2 things. One is these nominal sales numbers are being confounded, at least on the goods side, especially. We know goods prices are falling, right? Gas prices, food prices, vehicles, all of that. Even things like furniture and things like the appliances, prices are coming down. It's not even like it's disinflation. It's like inflation rate is coming down. Prices are actually falling for a lot of these items. And I think that's confounding what we are saying in the retail sales data. Then the other thing is consumption is normalizing from goods to services. I mean, look at the box office, right? I mean, I saw Inside Out 2 with my kids and wife last weekend. We loved it. I know you went to see it and you took it.
I fell asleep. We went on like Father's Day, I think, or something. I said, I'm going to go take a nap. I took about a 2-hour nap, but apparently the kids loved it. So,
No, it was great. So, but it made $100 million opening weekend. It made over $100 million. I think $155 million opening weekend. About $100 million on its second weekend. It's the best performing movie this year, $286 million at the box office. And Dune, it just beat Dune 2. Dune 2 was also awesome for people who...
So you're a fan of that one. I know that.
But remember last year we were talking about Barbie, Oppenheimer being this big thing, or look, consumer strong. Well, guess what? This year, there's so many movies that are done better than Barbie and Oppenheimer, right? Dune, Inside Out 2, Planet of the Apes. These are all my kind of movies, by the way. So...
See, I want to see Bad Boys. I'm hoping to see you've seen that one yet or not?
I love oh my god, that growing up, that was like, like I've seen that so many times. The first one, the second one, okay, but I liked it too.
I like the second one where they end up in Cuba. I mean, they end up in Cuba in the second one. I mean, who saw that coming? I mean, anyway, I want to see that.
It's funny they didn't. We're not at like Bad Boys 4 or 5 now, and we're just at number 3. Considering there's like
Sonu, we're at 4. There was a third one. Bad Boys for Life was the third one.
Oh, I missed that. I didn't.
This is the 4th one now. So you did miss it. Oh my goodness. I would normally say let's cut out a mistake like that, but I think you need to be shamed. You need to be shamed. I mean, you know what? Will Smith needs to come up and smack you. That's what has happened. Will Smith will come and smack you for forgetting this one now. Am I allowed to say that? I don't know. Hopefully, it's a joke. It's a joke. Yeah.
So Bad Boys, it's on my list. So Beverly Hills Cop, that's what's on my list.
There we go. So consumer still looks strong. And industrial production, this came in a lot better than expected. Yeah. So if the retail was kind of weak or the consumer was kind of weak, industrial production looked really good, right? And so did manufacturing.
Yeah, no, manufacturing production is up just under 1%. And,
Mhm.
over the last 3 months, up 1.4% annualized. Remember, now here, this is the difference between retail sales and production data, right? Production
Yeah.
data is actually real. It is sort of inflation adjusted because it's measuring
Right.
volumes, right? So this is the hard data, and so different from what we see in the manufacturing survey data, PMI data. The ISM PMI has been below 55, oh goodness, about 2 years now. It's saying the
Yes.
manufacturing sector is contracting. Well, the manufacturing sector is definitely not contracting if you look at the hard data. It's not going gangbusters, but it's still solid. It's doing okay.
Hmm.
But there, beneath the hood, things are looking pretty good. I mean, across real critical sectors, right? I'll pick three. Auto production, right? The vehicle sector matters a lot. Assemblies, vehicle assembly is running ahead of pre-pandemic pace. Like I
Yeah.
said, that's a massive deal. It took 4 years to get here, right? But that's good for prices as well, because what happens if assemblies are running strong? You get more dealer inventories, sales go up, and it pushes prices lower, right? So I think that's a very positive story. And then the AI story shows up in high tech equipment production, things like communication equipment, semiconductor chips, all of that. That's up 8% year over year. Again, all this is real. This is sort of inflation adjusted, right? It's up 26%, Ryan, since December 2019. Electrical equipment production, which is an offshoot over here, it's broken out of a decade
Hmm.
long stagnation. It's up 20% since 2019, right? It tells you something big is happening under the hood of the economy. And we saw a similar surge back in the mid 90s. So this is where AI shows up, right? Third story, finally, defense production, right? It's
Yeah.
kind of unexpected. Like a lot of people think, oh, it's a Democratic president, so maybe defense spending falls. That's what they actually saw under the Clinton and Obama presidencies. Of course, we had a split Congress, all of that, and that's how spending. Part of the
Sure.
thing with spending falling is defense spending also falling. That's what we said in late 90s, even the early 2010s. But now defense equipment production is up 10% year over year. This is another boost to the economy. And I think this is something, you and I have talked about this. This is something that's likely to continue even after the election, irrespective of who wins.
Yeah, you've been talking about that. We're probably going to see a lot of spending, probably continued deficits, and more on defense spending. And that's something Neil Dutta brought up. Gee, almost probably maybe a year ago. I don't
Yeah.
remember. A while ago, Neil said defense spending as a percentage of GDP is like historically low. That's probably going to go higher. And Neil is dead right, as Neil has usually been on a lot of these things. So, we also saw, and we were kind of getting near the end, so make this a little quicker. The PMI data, again, this is survey data, but US PMI composite was the highest since April of 22. So the composite looks at manufacturing and services. Both of those, manufacturing's at a 3-month high, services at a 26-month high. I mean, it's soft data, but hey, it's
At least it's going in the right direction.
it seems like it's going where the real data is going. With the real data has been saying that the whole time. Well, also, I do want to point this out. Citigroup increased their S&P 500 target from 5,100 to 5,600 last week. Who's CE? Capital Economics, right? Capital Economics, 5,500 to 6,000. Evercore ISI was the biggest bear at 4,750. They go all the way up to 6,000 and talking about maybe 7,000 down the road. Goldman was from 5,200 to 5,600. And even our friend Ed over at Ned Davis Research, he did a pretty big increase in his. I didn't quite write it down, but I know he did. So we're seeing, is Wall Street just playing catch up? Should we be worried when the biggest bear at ISI is now the biggest bull? My head spins on this. It concerns me, yes, but I'm not saying it's the end of the bull market. What do you think, Sona? Maybe probably about the last thing we have time to talk about.
Yeah, and we'll go back. We'll round it out. I'll connect it to something you brought up at the beginning of this. So the S&P is close to not quite at 5,500, but it's close, right? So everyone seems to be 56, 5,700, which is not a big increase. What, 4% from here
right now
for the second half of the year? But just using your stats, historically, second half of the year. See, this is where my memory serves me right. About 5%, 5.5%. That's what he said.
Median
Return.
Mm-hmm, yep.
But then in the presidential election year, it's better. And then when you have a lot of new highs, we had 31 new highs, more than 20
Even
new
better.
highs first half of the year. We're at 9.7% median, right?
Yeah,
second half of the year.
Yep.
So Wall Street is bearish relative to all of that data you just gave us at the top of the podcast.
Yeah, no, well said there. So again, we won't be back for 2 weeks. So, anything major on your radar for 2 weeks people should be paying attention to?
No, I think the only data point really is July 4th. No, core PCE too. Core PCE will come out, which is the personal consumption expenditures index that the Fed likes to follow rather than CPI. I think that's going to be soft given what we already know from CPI, PPI. We've talked about this a couple of weeks ago. So I think that should be soft. Hopefully, I think I'll end with this. I mean, to paraphrase something Neil Dutta said, the Fed needs to get on with it and cut rates at this point. It's hurting housing. It's not like, I know Kashkari, the Minnesota Fed governor, likes to say, oh, maybe high rates are not having an impact on the economy. No, it is having an impact. We see that in housing, it's having a negative impact. So they need.
You're going to Minnesota today, right?
Yes, I'm going to Minnesota.
Maybe you can tell them. Maybe just listen here, sir. Are you looking at this data? Anyway, so again, this was episode 91, why even Nvidia can't stop this bull. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We'd love to hear your feedback. Oh, and Chelsea, our producer, says, I love Cookout. Yes, I know. I mean, Cookout's awesome. I mean, it is. And we're starting to do more emails, or trying to get more interactive with our listeners out there. Facts versus feelings versus VS. Facts versus feelings at carsongroup.com. Please send us anything you want. Anything you want us to talk about, any feedback on the show. If you love Cookout, if you hate Cookout, if Neil should, I'm sorry, if Sonu should go up to Kashkari and say something, let us know. Again, we're not doing one next week, so everyone have a happy and safe July 4th. Be careful with the fireworks and your fingers and all that stuff. And then we'll be back in 2 weeks to release our mid-year outlook, eyes on the prize. So take care, everybody. We'll see you next. No, we will not see you next week. We'll see you in 2 weeks. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.